Hey guys, Toby Mathis here, one of the founding partners of Anderson Business Advisors. And I wanted to talk today about the BRRRR method of investment. That goes for BRRRR. Now it stands for buying a property, rehabbing that property, putting a renter in that property, refinancing that property, and then repeating that process with another property. So you're pulling the equity out of that property once you get it performing. And something really critical to this methodology is understanding the different way to value real estate. Most of us are used to what we've always heard, which is you buy a house and after 30 years, it's going to be so much more valuable. You can sell it or you can refinance it. You can send your kids to college on it, all that stuff. They're basing that on appreciation, and they're basing on something called comp valuations, which means they're looking at the neighborhood itself and determining what that house is worth based off of what the average square footage or price per square foot is in that community. You know, you're doing everything from proximity to schools, et cetera, yada, yada, yada. When you're an investor, you tend to look at cash flow, which means we're valuing it off of what it pays us. And in commercial real estate, that's almost exclusively how it's done. And they're using something called a cap rate. And a cap rate's a fancy way of saying what's the percentage return based on the value of that property. So if I have a property that's worth $100,000 and it's returning $10,000 into my pocket every year, net, not gross, net, meaning that I'm actually getting to put $10,000 in my pocket, then that is a 10 cap. So the easiest way to know this formula is you just take the net operating income, the net income. So they call it net operating income. So it's not your gross rents. It's what you actually get to keep after your management fees, your repairs, your insurance, property taxes, etc. And you get down to that bottom line and you divide it by the fair market value of that property, and that's going to get you a cap rate. So this is where it gets really, really fun when you're doing the BRRRR method. And one of the great things about real estate, anybody who's been doing it a long time knows that the holy grail of real estate is cash flow and not having a bunch of debt on a property. But sometimes you lever up that property to continue to grab more property and to gain more equity. So that's not necessarily a bad thing, but negative cash flow is fatal. Owning real estate is awesome, but owning real estate with too much debt can topple you. So using the BRRRR method, you could avoid having that happen if you know your numbers. So the first part of that equation is buying a piece of property. And I'm just going to tell you from my experience, I've been doing this for 20-something years, I have over 200 properties, and I can tell you that what you end up looking for is usually a property where you can buy it and improve it for about 75% or less of its fair market value, what we call an after approved value or improved value. So you're looking at something that you buy, let's say you buy it for $40,000 and you know you're going to put $50,000 into it. In other words, you're buying something that's pretty beat up, but it has a lot of potential. It's in an area where you know the rents are really strong and you believe that you're going to buy a project, fix it up, and that it's going to be worth, let's say, $120,000 after it. Using simple math, we could say 75% of 120 is three quarters of it, or $90,000. So we would be right on that line. We could buy it for 40, put 50 into it, then we would be maxed out right around $90,000 if the fair market value was worth that $120,000. Now that's if you're just going in and traditionally financing it. If we're looking at it from an investor standpoint, you're going to use the cap rate and what it's actually returning, and then we really care about those rents. And so a simple way of looking at this is if I am going to get rents on that property, let's say that I buy it for $40,000, put 50 into it, it's worth $120,000, but I can get $1,500 a month in rent. And $1,500 a month in rent is really going to return to me somewhere between $750 and $1,000 a month after all my fees and expenses and everything else, which is going to put me somewhere in the $9,000 to $12,000 a year range. That's a pretty good return on that. Then you refinance it. And let's say we're going to take whatever we built out of that and we're going to refinance that. We're going to take that 90,000 and we're going to refinance it. That puts us somewhere in the neighborhood on a refinance on that would probably be around $600-700, somewhere around between $600 and $650 a month, somewhere in the 4% range if we're doing a traditional financing. And that's what rates are right now. They can go up and down. But if you did a 30-year fix, 4%, 1% property taxes, probably $1,000 a year in insurance, you're going to be somewhere in the $600 range on a monthly basis. That tells me that we can actually positively cash flow that property. If we are doing a refinance, then we have to determine whether we're going to use a comp rate refinance, which is a traditional way of handling refinances. So if you're buying it in your name, you can do about 10 properties max in your name under a traditional financing. If you go above that amount, you have to go the commercial route and you have to be very aware of your cap rate. If you have, we'll use those same numbers I threw out there. So if you're making around anywhere from $750 to $1,000, you're making $9,000 to $12,000 per year cash flow. That's if you're renting it for $1,500. So I'll walk you through this again. $1,500, I'm probably going to get to put in my pocket somewhere in the neighborhood of $750 on the low end to $1,000 a month on the high end in cash. That's what's going to go in my pocket, which means my range is going to be between $9,000 and $12,000 a year, which means if I have $90,000 into it, my cap rate on my $90,000 investment is about 10%. So my cap rate is 10. If it's worth 120 and I'm using that as my basis to get my loan, I'm still between a 7.5 and a 10 if I use those numbers. So between 90,000 and 12,000, or excuse me, 9,000 and 12,000 a year of cash flow. Obviously, 12,000 divided by 120 is going to be 10%. You're going to probably get that loan. Like that shouldn't be a big problem. Most of you guys, if you're just getting started, you are going to use traditional financing. Now, here's how this is powerful. I bought something for 40. I put $50,000 into it. I am now $90,000 into this property. I refinance it based off of its fair market value, which is 120. In other words, I improved this property. I have now earned 25% of that property as equity. And so I refinance out the 90,000 and I go and do that same thing again. I now have $30,000 of equity and I have positive cash flow somewhere in the neighborhood of 150,000 to probably closer to, what would that be on a monthly basis, 12,000, 1,000, so 250, so about $400. So I'm going to have positive cash flow of about $150 to $400 a month. That's fantastic. And I go and do the same thing again, and I get the same result, $30,000 equity, positive cash flow. And if I do that repeatedly, let's just say I did that 10 times, now I have $1,500 to $4,000 a month coming on, and I've got $300,000 of equity in that property. And what's going to end up happening is over the years, as that property appreciates, the fair market value is going to increase. Historically, these properties grow at around range right around 4%. Let's just say that 5 or 6 years from now, your $300,000 of equity should be substantially more. Let's say it's $400,000. You can now pull even more out and start doing the same process again. The most critical component of buying, rehab, rent, refi, and repeat, to me, is how you identify and purchase that property. It's all in the very beginning, making sure you know your numbers, making sure you have good financing, because that refi part really becomes critical. You got to have your financing lined up before you walk through the door. There's places that will actually finance even the purchased and the rehab, all the way up to 100% of the rehab costs, but it'll be hard money, which means it's really expensive. You need to have an exit so you can pull the money, take those people out, and then just keep repeating the process. And if you caught that last part about having the hard money, there's people that'll loan you 100% of the purchase, 100% of the improvement. So the $40,000 we buy it for, the $50,000 we put in it, there are people that will give you that $90,000. but they're going to charge you probably $9,000 or $10,000 for that money for the year or 6 months or whatever it takes to do the refi. It might be a little less, but it's going to be pretty darn close. This is critical. You got to do the math then on that purchase. And so again, rule of thumb for me, 75% after repair value, I'm going to be pretty safe. It means that I'm going to be able to refi that property at 75% of its after repair value and repeat the process over and over again. At the end of the day, it's all about accumulating and having cash flow. Cash flow is king and allow you to continue to expand. And there's nothing better than having a whole bunch of passive assets like real estate that are just kicking off income, whether you're in Fiji, whether you're or Fiji, or whether you're in Hawaii or just chilling out at your house. It just takes so much pressure off knowing that you have that income coming in month after month, year after year, decade after decade. It just takes so much pressure off. So good luck on your BRRRR strategy.